The month of November was greeted by the most awaited Federal Reserve meeting, and they decided to keep interest rates on hold for the second meeting in a row. This means that the current federal funds rate is sitting between 5.25% and 5.5%. This decision was widely expected before the meeting. Today, we're going to discuss what this decision means for you, your investments, and the housing market. But first, let's recap what happened at the meeting. If you take a look at the charts, you'll see that interest rates have been steadily increasing since 2022. However, what's interesting is that this is the first time they've paused 2 times in a row. That's a positive development. During the meeting, the press release stated that recent indicators show a strong expansion of economic activity in the third quarter. Job gains have moderated, but they remain robust, and the unemployment rate is still low. Inflation remains elevated. This information was similar to what they said in their September 20th, 2023 press release. Now, let's look at how the market responded. The market reacted positively to the news. The S&P 500 increased by 1%, and the Nasdaq went up by 1.64% on the day after the meeting concluded. Now, let's listen to what Jerome Powell had to say about economic stability and the prospects of economic growth in the third quarter. Jerome Powell mentioned that economic activity has been expanding at a strong pace, surpassing earlier expectations in the third quarter. Real GDP is estimated to have risen at an annual rate of 4.9%, mainly due to increased consumer spending. A growth rate of 4.9% in GDP for the third quarter of 2023 is quite high. To put it in context, if we look back to the first and second quarters of 2022, we had a technical recession with negative growth. Since then, the economy has been growing in each subsequent quarter. This latest quarter is the most robust performance we've seen since the third quarter of 2022. So, the economy is looking up. You might be wondering if a recession is still on the horizon. We'll discuss that later in this video. For now, let's look at some changes in the Consumer Price Index, CPI, from the previous month. CPI, or inflation, is something the Federal Reserve considers when deciding whether to adjust interest rates to combat inflation. In September 2023, the Consumer Price Index, CPI, stayed at 3.7% for the 12 months ending in September, showing no change from the previous month. If you take a look at this handy chart, it breaks down the inflation for September 2023. You can see that prices went up for various items compared to the previous year. But the critical factor to note is the price of gas, which only saw a 3% increase. To put it in perspective, in August 2023, the inflation rate for gas was at a whopping 10.6%, so it's clear that gas prices have come down significantly. However, the core PC, personal consumption expenditures, rate remains at 3.7%, which is still a bit higher than the Federal Reserve's target of 2% for inflation. Now, let's hear what Jerome Powell had to say about job growth and labor demand. He mentioned that nominal wage growth has shown some signs of slowing down, and job vacancies have decreased so far this year. However, even though the gap between available jobs and job seekers has narrowed, there's still more demand for labor than there are available workers. So, what does this mean? In September, the US added 336,000 jobs, which is a substantial increase compared to the numbers in August, July, and June. While this might raise concerns in some scenarios, the main reason it's not a cause for alarm is that wage growth has actually slowed down to levels similar to those before the pandemic. To explain further, there was a period where adding too many jobs, while wages kept rising, could have led to what's called a wage price spiral. Here's a simple illustration to clarify this concept. When wages increase significantly, production costs for making various products or services go up. For companies, this means they might have to raise the prices of their goods to compensate for higher labor costs. The good news is that this doesn't seem to be happening right now, especially since the average hourly wage earnings only grew by 2% for the month, which is below the economist's average forecast of 3% or 4.3%. So, for now, it appears we're not caught in a wage price spiral. The November Federal Reserve meeting, where they maintained interest rates at 5.25% to 5.5% for the second consecutive meeting, was highly anticipated and signals the Fed's cautious approach amid rising rates since 2022. Economic expansion in the third quarter, robust job gains, and elevated inflation were highlighted. The market responded positively, with the S&P 500 and Nasdaq gaining. Jerome Powell's comments on a 4.9% third quarter GDP growth rate are encouraging, contrasting with the 2022 recession. Concerns about a future recession persist. Inflation remained at 3.7%, with notable gas price decreases, but the core PCE rate is above the Fed's 2% target. Wage growth has slowed, but the strong job market maintains balance. In summary, the Fed's decision reflects a cautious approach, and the economic outlook appears promising despite challenges. Now, let's shift our focus to the housing market. The median sales price of homes in the United States was $418,500 on average. However, in Q3, we've seen an increase in housing prices. The median sales prices of homes have gone up. Furthermore, mortgage rates are currently at 8% for a 30-year fixed mortgage, which is notably higher than it was before at 7.5%. Looking at existing home sales in September 2023, they've dropped to the lowest level since October 2010. It seems like people are holding back from buying homes, likely due to their increasing prices and the high mortgage rates. Even though it's stated that housing has cooled off, the data shows that median sales prices of existing homes have either remained stable or gone up in most regions. It's a bit different from what Jerome Powell and the Federal Reserve are saying, so the situation seems to be somewhat mixed. On a positive note, housing starts had fallen to their lowest point since 2020 in August. However, they've since recovered, which is a promising sign. We'll have to wait and see how the housing market develops in the coming months. Personally, I believe it could be a good time to buy a house, especially if you have cash on hand. With high mortgage rates, sellers might be willing to lower their home prices, and there might be fewer buyers in the market. But remember, this is just my personal opinion, and I'm just a YouTuber on the internet. Don't base your purchasing decisions solely on this. Regarding the Federal Reserve's actions, traders are currently pricing in a 22.5% chance of a rate hike in the upcoming Federal Reserve meeting on December 13, 2023, and a 78% chance that rates will remain unchanged. These probabilities are subject to change as we move through future Fed meetings. In January 2024, there's a 2.3% chance of a rate increase to 5.5%, and in March there's a potential for a cut to 5%. By May, it becomes a bit unpredictable, depending on the economic data and the Federal Reserve's evaluation. In Jerome Powell's words, "In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. They will make decisions meeting by meeting, considering all incoming data and their implications for the economic outlook, activity, and inflation, as well as the balance of risks." Thank you for joining us in exploring the essential steps to prepare for 2024. Embrace a long-term perspective, stay calm during market ups and downs, manage debt, and ensure financial security. If you found this advice valuable, please like, share, and comment. Your feedback drives our content, so make sure to subscribe for more insightful updates. See you in our next video.